Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Vipshop stock so we can determine if it's a buy or a sell. Vipshop is an online discount store. They're the third largest e-commerce site in China, behind Tmall and JD.com. Tmall is owned by Alibaba. Let's get started with the model. This is a mid-cap company, 9.4 billion market cap. They're trading at $17 a share, and they have 562 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had 1.3 billion in 2020, it dropped to 440 million in 2021, back up to over 1 billion in 2022. I don't have their free cash flow for the trailing 12 months, so I just put in 2022's number. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's in a fairly tight range, 829 million in 2020, close to 1 billion in the trailing 12 months. Revenue is the sales for the company. That was highest in 2021 at 16.4 billion. Now it's a little under 15 billion. Not that much growth since 2020. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 17 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $15 billion. We divide that by 560 million shares. And we get a calculated stock price of $26. They're trading at $17, so they're trading at a 36% discount. It's a pretty strong buy according to the model. There are 44 companies in the same industry as Vipshop, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. It doesn't look like they have much debt. Their debt to equity ratio is 0.1. That means for every dollar of equity, they have 10 cents of debt. They do generate a good amount of free cash flow, a little below the average. They rank 11th in market cap. Amazon is number 1. A distant number 2 is Baba. PDD Holdings is a distant number 3. They have a good price to book, 2.1, a lot better than the average, a little worse than the median. This means investors are paying $2.10 for each dollar of equity. A really good PE at 9.5, a great price to free cash flow, 9.1, both a lot better than the median average. And price to sales a little better than the median, 0.6. Their revenue is a lot higher than their market cap. That's why their price to sales is below 1. But their 5-year annual revenue growth rate is only 5%. They're not really growing that much. Let's take a look at their first quarter financial results. They're located in Guangzhou, China. They're a leading online discount retailer for brands in China. Revenue up 9.1% in the first quarter of 2023. That's compared to the first quarter of 2022. 27.5 billion renminbis, or 27.5 billion ren. I have a hard time pronouncing the currency for China. It's spelled Y-U-A-N. It's not yuan. That's not how they say it. They pronounce it like W-R-E-N, ren, which is hard for an American to say. It does sound like yen, the Japanese currency, but it's pronounced ren. Luckily, they also list US dollars. In the first quarter, 4 billion US dollars. If you want to convert from ren to US dollars, you can usually just divide by 7. And of course, if you want to convert from US dollar to ren, then you just multiply by 7. GMV, gross merchandise value, up 14% to 49 billion, or about 7 billion US dollars. Gross profit up 18%, that's a big increase, to 859 million US dollars. Net income up 70% to 271 million US. Their active customers increased 4% to almost 44 million. China is a massive country, so there's a lot more people they can attract. But Tmall is the biggest by far. That's Alibaba's website. Tmall has about 500 million customers, so about 12 times as many as this company. The number of orders up 11%. To 184 million. No conversion necessary. If you weren't sure what GMV stands for, they do footnote it. Gross merchandise value is the total renminbi value of all products and services sold through the company's online marketplace. They also footnote active customers, footnote 3. Active customers is defined as registered members who have purchased from the company's online sales business or the company's online marketplace platforms at least once during the relevant period. So 44 million people purchased at least once in the first quarter. Some people twice, some people 100 times. Revenue up 9%. That's from the growth in active customers and spending. Gross margins improved from 20% to 21.4%. Operating expenses increased 4% to $591 million. As a percent of revenue, operating expenses are 14.7%. Last year, 15.4%. Fulfillment is their main expense. That increased 5% to $260 million. But it is down as a percent of revenue. It's 6.5% of revenue. Last year, 6.7%. Marketing up 10% to $122 million. As a percent of revenue, it was 3% this year and 3% last year. Technology expenses up 0.75% to $57 million. As a percent of revenue, it's 1.4%, which is lower than last year of 1.5%. G&A is down 0.7% to $153 million. 3.8% of revenue, down from 4.2%. Operating income increased 55%. That's really promising, to $289 million. Operating margin increased from 5.1% to 7.2%. Operating margin is operating income over revenue. Net income increased 70% to $271 million. Margins have improved a lot from 4.3% to 6.8%. 588 million ADS, American Depository Receipts. ADSs are the foreign stocks held by the custodian. We actually buy ADRs, American Depository Receipts. ADS stands for American Depository Shares. They do have a lot of cash, over $3 billion of cash, $2.8 billion of actual cash, $217 million of short-term investments, which is pretty much cash. Their operating cash flow in the first quarter was $67 million. CapEx, investments in property, plant, and equipment was $160 million. So free cash flow was negative $100 million. I prefer to invest in companies with positive operating cash flow. I could handle negative free cash flow as long as they have positive operating cash flow. They mentioned they fully utilized their $1 billion in share repurchases, and they authorized another $500 million in share repurchases. And they could spend that $500 million anytime before 3/31/2025. They appointed Mr. Mark Wang as CFO, effective May 24th. I'm going to try to do more due diligence on the executives at the company. That's something I really don't do much of, because it seems like everybody has a solid background. It's hard to find if anybody has real dirt on them. Before joining Vipshop, Mr. Wang was CFO of Benlai Group, an online fresh grocery player in China. This is a red flag because he was only there 18 months. Why so short? For 3.5 years, he was at Xiaomai Corp. For the second quarter of 2023, they project 27 billion ren, which is about $4 billion US, an increase of 10 to 15% over the prior year. Here's their income statement. 3.8 billion in product revenue in the first quarter, 230 million in other revenues. They footnote that. Let's see what that means. It looks like most of their other revenue is advertising. Other companies probably buy advertising space to put on their platform. Also, lease income, fees charged to third-party merchants, revenue from third-party logistics services, loan facilitation service income, and membership fee income. So total revenue, $4 billion US. In the Chinese currency, it's 27.5 billion, up from 25.2 billion. All the expenses directly tied to generating the revenue is 3.15 billion. So gross profit, 859 million, up a good amount from last year. It's up almost 20% because last year was 5 billion, now it's 5.9 billion. Fulfillment expenses, 259 million. Fulfillment is the shipping and handling expenses. Marketing, 121 million. Technology, 57 million. G&A, 152 million. Total expenses, 590 million. Other income of 21 million. Operating income of 289 million. $6 million gain on investments. Interest expense of 830,000. Interest income of 32 million. 57 million of taxes. net income of $270 million. Their earnings per share are $2.33, so their EPS is $16.03 in the Chinese currency, double last year. Let's look at their balance sheet. $2.6 billion of cash, $136 million of restricted cash, $217 million of short-term investments. They sold $87 million of products on credit, so they should receive that money sometime in the near future. $29 million due from other parties. Other receivables, $318 million. And of course, they have lots of inventory, $591 million. Current assets of $4 billion. Current liabilities of $3.3 billion, so their current ratio is above 1. They have a lot of fulfillment centers, warehouses, so their property and equipment is $2.4 billion. $1.1 billion of land. Non-current assets, $4.6 billion. Total assets, $8.6 billion. It looks like they buy a lot on credit. They have $1.7 billion of accounts payable. Accrued expenses of $1.1 billion. These are expenses the company has incurred but has not paid it yet. And they have $400 million of non-current liabilities. So $3.7 billion of total liabilities. They bought back $1.6 billion of their own stock. They raised $1.9 billion from selling their business. They profited $4.5 billion from running their business. So total equity is $4.9 billion. Last year they had 135 million shares outstanding. Now it's down to 116 million. So they're doing a really good job at reducing their shares. When a company buys back its own common stock, that decreases the shares outstanding, making your shares more valuable. Let's take a look at VIPS on Simply Wall Street. It's trading at $16.73, 9.4 billion market cap. Up a lot, up 67% in the past year. It was founded in 2008, 15 years ago, 6,800 employees. Vipshop operates online platforms in China. It operates VIP.com, Shan outlets, and other segments. They offer women's wear, menswear, sportswear, shoes and bags, accessories, baby and children products, skincare and cosmetics, home goods, and other lifestyle products and supermarket products. It also provides internet finance services, including consumer and supplier financing. So they provide loans to businesses and consumers. In addition, the company engages in warehousing services, retail business, product procurement, and software development and IT support activities. They provide branded products through its VIP.com and Vipshop.com online platforms, also through retail stores. They were founded in 2008, headquartered in Guangzhou, China. Guangzhou is the capital of the province Guangdong. It's in the southern part of China. The reason their headquarters are in Guangzhou is because it has a major port and transportation hub, and it's one of China's largest cities. And for a while, this was the only Chinese port accessible to foreign trade. But now there's other trade ports in Hong Kong and Shanghai. Let's go back to Simply Wall Street. Here's where the stock has been trading since 2012. They've done one stock split, a 10-for-1 in 2014. And if you invested $10,000 into this company 10 years ago, you'd be pretty happy. You'd be at almost $57,000 today. That's a 19% annual return, a 467% total return. At one point, your $10,000 would have been $130,000. The stock had a really nice run up from 2012 to 2015. It hit almost $30 a share. Then it did struggle for 6 years, coming down a lot to about $5 at its low point. In the beginning of 2021, it finally broke through its 2015 levels. It reached a peak of $45 in the first quarter of 2021. Like most stocks, especially Chinese stocks, it really crashed in 2021. It hit a low point at the end of 2022, about $7 a share. But it's up about 140% from that bottom, sitting around 17. So it looks like a really good value at this point. Here's a news article from June 12th. Is now the time to put Vipshop on your watch list? Let's click into the article. It may seem like a good idea to buy a company that tells a good story to investors, even if it currently lacks a track record of revenue and profit. But a quote from Peter Lynch, long shots almost never pay off. And I totally agree with him. Loss-making companies are always racing against time to reach financial sustainability, so investors in these companies may be taking on more risk than they should. How quickly is Vipshop Holdings increasing earnings per share? The market is a voting machine in the short term, but a weighing machine in the long term. Vipshop has managed to grow EPS by 30% per year over 3 years. Their EBIT margins have improved from 4.6% to 6.8%. Their revenue is down 7.4%. That's year over year, not quarter over quarter. So you can see their revenue peaked at the end of 2021, and it's down a little bit since then. I don't really like this article too much. There's a lot of fluff. Let's go back to the main part of Simply Wall Street. Their PE back in 2018 was 13. It was as high as 21 at the end of 2020, but it looks a lot better now because the stock has come down quite a bit. It's a 9x. They're trading at 9 times earnings. Their price to sales was 0.3 in 2018, 1.2 in 2020, now it's 0.6. So their revenue is higher than their market cap. Price to book 1.7 in 2018, as high as 4.3 in 2021, and this number has improved a lot. It's down to 1.9. Simply Wall Street's valuation is 33. They say the stock is 50% undervalued. 23 analysts say the stock is 8% undervalued. Their trailing 12-month revenue is 105 billion yuan. The forecast is 125 billion by the end of 2025, which is about 18 billion US dollars. Their earnings are 7.06 billion. Forecast is 7.7 billion by 2025, or about 1.1 billion US dollars. Their trailing 12-month revenue in 2012 was 3.1 billion. Look how much their revenue has grown from 2012 up to 2019. That's almost an exponential growth. It got up to 93 billion. It peaked at 119 billion. This is the third quarter of 2021, but it has come down to 105 billion. There's lots of competition in e-commerce, especially with Tmall, Alibaba. There's also JD.com. They generally don't keep that much debt on their balance sheet. The most debt they had was 7.5 billion in 2018, a little over 1 billion US dollars. Now they have 1 billion. Their debt to equity ratio is 3%, which is really attractive. So for every dollar of equity, they have 3 cents of debt. They don't pay a dividend, but it looks like analysts are forecasting them to pay a really small dividend, 0.003%. That's by 2025. Eric Shen has been the CEO for 13 years. That was my pediatrician's name when I was growing up, Dr. Shen. That was when I lived in the beautiful island of Staten. 59% of the company is held by institutions, 25% by insiders, and 16% by public companies. Eric Shen, the co-founder, is the biggest shareholder at 15%. His valuation is 200 million US dollars. They only had 5,000 employees in 2012. It got up to 59,000 in 2017, but it took a big drop. It's down to 6,800. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, and Sao Paulo Bolsa. So that's the end of the video. Let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.